Have you ever wondered what really goes on behind the scenes, after a major company releases its quarterly financial results?
Mm-hmm.
It's not just about crunching numbers, is it?
Mm-hmm.
It's really about unlocking the strategic plays, the underlying challenges, and sometimes the surprising turns that shape a media giant.
Exactly.
Today, we're taking a deep dive into the recent Q1 FY26 financial results of Zee Entertainment Enterprises Limited. They're obviously a prominent player in India's dynamic media and entertainment landscape.
Yeah, big one.
We've pulled together their official financial statements, the detailed auditor reports, and key insights from their management during the recent earnings call.
Right, and our mission here is really to help you cut through all that dense financial jargon, the sheer volume of information, frankly. We'll extract the most important nuggets of knowledge, explore what truly drove these results, shed light on their ongoing strategic initiatives.
And those legal developments, too.
Absolutely, and reveal some fascinating legal and operational developments you probably won't find in just a quick headline. By the end of this deep dive, you should have a clear, actionable understanding of Zee's recent performance and, what it means for the broader industry.
It really helps you spot those aha moments.
It does.
So let's unpack this. These results are pretty much fresh off the press. Approved by Zee's Board of Directors on July 22, 2025, for the quarter that ended June 30, 2025.
So very current.
It's the latest snapshot of their financial health. To really understand the strategic shifts happening at Zee, we have to begin with the bedrock.
Yeah.
The raw financial numbers.
Always start with the numbers.
What do those top-line figures immediately tell us? Looking at the consolidated results for Q1 FY26, Zee reported an operating revenue of $18,248 million.
Okay.
Now, what's interesting here is this marks a 14% decline compared to the same quarter last year, Q1 FY25.
Right, a noticeable dip.
Yeah. However, on the profit front, the story gets a bit more nuanced.
Well, yeah, and what's fascinating here is how they achieved that nuance. While their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a core measure of operational profitability.
Right.
It saw a 16% annual decline, landing at $2,280 million with a margin of 12.5%. But the profit after tax, the PAT from continuing operations, actually increased.
Increased, despite lower revenue.
Increased by 14% year over year to $1,437 million. This PAT increase, despite revenue and EBITDA falling, is a clear strategic success story, isn't it? It tells us Zee is prioritizing profitability through efficiency over just raw top-line growth right now.
Yeah.
And that's largely thanks to aggressive cost optimization, especially within their digital segment, ZEE5. It's a very calculated move to shore up their foundation.
That is a significant strategic move. So if we drill down into the three main revenue categories, how did each contribute to this overall picture?
Well, okay. Advertising revenue came in at $7,585 million. Management highlighted that domestic advertising revenue specifically declined by 19% annually.
Right. 19%. Wow. Why was that?
Primarily due to an extended sports calendar and also a slowdown in FMCG, that's fast-moving consumer goods spending. They basically describe the domestic advertising environment as soft.
Soft. Yeah, that makes sense. So with advertising facing those headwinds, is the digital realm picking up the slack? What's the story with subscription revenues?
Subscription revenues were $9,817 million. Now, that remained largely flat year over year.
Flat, okay.
But the management noted growth in digital revenue was offsetting a slowdown in linear TV subscription, which actually saw a decline in pay TV subscribers.
Interesting dynamic there. Digital up, linear down slightly.
Exactly. And finally, other sales and services. Well, they declined significantly compared to the prior year, coming in at just $846 million.
And that was mainly?
Largely attributed to lower theatrical and syndication revenue. Fewer big movie releases or deals in the quarter compared to last year.
Got it. So if you're thinking about the broader media landscape, you can already start to see the shifts pretty clearly. Digital pushing ahead, but traditional advertising and content sales facing, considerable headwinds.
Definitely.
But the operational front reveals some truly compelling dynamics, despite that industry softness we mentioned.
Yeah.
Zee's all-India TV network share actually grew. It grew by 40 basis points, that's 0.40 percentage points compared to the previous year, reaching 16.8% in Q1 FY26.
That's quite strong in this market.
And get this, in June alone, it hit 17.8%. Management was saying it even crossed 18% in July. That's a nearly two-year high.
Wow. So they're gaining eyeballs on traditional TV.
Seems so. This growth is clearly fueled by a sharp focus on quality content across languages. They noted strong performance in key markets like Hindi, Marathi, and Bangla.
That's impressive, especially when, the conventional wisdom suggests linear TV is just in decline.
Yeah.
What do you think is the core differentiator for Z that allowed them to sort of buck that trend?
Good question. Maybe it's that content focus you mentioned.
I think it leads us to a key insight.
Hmm.
They're kind of dual engine resilience. They're not abandoning traditional TV. They're actually revitalizing it while simultaneously and aggressively conquering digital.
Ah, okay. So not either, but both.
Exactly. This dual focus on both linear and digital is, I think, a key competitive edge in India's evolving media landscape. And ZE5, their digital arm, is a clear bright spot here.
Yeah. Tell us about ZE5.
Okay, so its revenue increased by a healthy 30% year over year in Q1 FY26, reaching 2,900 million.
30% is strong.
Very strong. And crucially, ZE5 also saw a significant reduction in its EBITDA losses, down by all 119 million compared to the previous year.
That's huge, getting closer to profitability then.
That aligns perfectly with their stated objective to achieve break-even for ZE5. They launched 17 shows and movies, including 5 originals. And what I found most interesting, they introduced tailored subscription plans in 7 languages.
Oh, language-specific plan.
Yeah. It was a direct response to consumer feedback, people saying they didn't want to pay for languages they don't consume, and apparently it's already showing traction.
That's a significant turnaround for ZEI5. Does this imply they've really found a sustainable path to profitability, or are there still major hurdles to cross before true break-even?
Well, they're certainly on the right path, especially with that continued cost discipline we talked about.
Right.
And beyond ZEE5, they've also launched this microdrama platform called Bullet.
Bullet, what's that?
It's through a partnership with a content and tech startup. The aim is to cater to young audiences with short-form but high-quality content. Think quick, engaging stories.
Interesting new venture. And costs overall.
On the cost side, the overall operating cost declined by 14% year over year. That was driven by efficient execution in programming technology and, as we said, continued cost optimization in ZEE5.
Even with new spending.
Even with some additional expenditure for rebranding and those new language packs for ZEE5.
So they're building new avenues while definitely tightening the belt on costs. What about their other business segments, like movies and music?
Right, beyond TV and OTT. Their movie business released 7 films in Q1 FY26, 3 Hindi and 4 regional movies.
Okay.
Management did say it was a bit of a lean movie calendar compared to the previous year, but Zee Music Company continues to be a strong player.
Yeah, their music channel is huge, isn't it?
Massive. Added 4.4 million YouTube subscribers just in the quarter, reaching 168 million total subscribers now.
Wow.
And garnered over 62 billion total video views across its channels. They're also actively expanding their music catalog into other language markets, which seems like a smart move for broader reach.
Definitely. Okay, that's a comprehensive look at the numbers and the operations. But, a company's story isn't just about financials and content.
Never is.
Beneath the surface, there's often this complex web of legal and regulatory challenges they're actively navigating. What's sort of bubbling beneath the surface for Z that we need to be aware of?
Yeah, and this brings us to a really crucial area for any major corporation like this. The company's independent auditors, Walker Chandiok & Co., LLP, they issued an unmodified conclusion on the financial results.
Which is good, right?
That's a good sign, yes. It means the auditors found no significant misstatements or accounting irregularities in their reported numbers. However,
There's always a however in auditor notes.
Often is. They did draw attention to several ongoing legal matters that are pretty important to understand.
Okay, so what are these key matters? Especially on the regulatory front, what's happening with SEBI and the MCA?
Well, this raises an important question about regulatory oversight, doesn't it? There's an ongoing investigation by the Securities and Exchange Board of India, SEBI, that's India's main market regulator,
Right.
and also an inspection by the Ministry of Corporate Affairs, the MCA, concerning certain transactions. Now, an independent investigation committee, the IIC they formed, concluded there were no material irregularities and that transactions were just in the normal course of business. But a settlement application with SEBI has since been rejected.
Rejected. Okay, so that's significant because...
It's significant because it means the investigation will likely continue. It keeps that regulatory scrutiny on the company until some kind of resolution is reached. Even if Z maintains it doesn't expect any material adverse impact, the uncertainty remains.
Got it. It seems they're fighting battles on many fronts. Then how does that impact their core strategic focus? do you think? And what about that very substantial claim from Star India? That sounds huge.
It is huge.
So,
That's probably the most significant ongoing legal tussle. It's with Star India Private Limited, which is now GeoStar India Private Limited, concerning broadcasting rights for ICC cricket events.
right, the cricket rights.
Star is claiming a substantial USD 1,003 million in damages as of April 30, 2025. That's actually up from an earlier claim of USD 940 million.
Over $1 billion, wow. And Zee's position?
Zee, on the other hand, has filed a counterclaim for USD 8 million plus interest. They're stating that Star acted in breach of their alliance agreement and that Star's claims are, quote, unfounded and legally not tenable.
Okay, so major disagreement there. What's next?
Evidentiary hearings in this arbitration are scheduled for November 2025, so we'll definitely be watching for updates there later this year.
Okay. Beyond these major regulatory and contractual disputes, are there other legal challenges that kind of paint a fuller picture of the complexities Zee navigates?
Absolutely. It's rarely just one or two things. Beyond the big SEBI and Star India issues, Zee is also managing a number of other ongoing legal and regulatory challenges.
Like what?
Well, they've seen some positive outcomes, like a favorable court ruling from the Mauritius Supreme Court on the ATL Media Limited put option that declared an amended agreement null and void.
Okay, a win there.
But other matters, like a contingent tax liability of $1,736 million from indirect tax authorities, that's related to a GST show cause notice.
So a potential future cost.
Exactly, a potential financial obligation that might arise depending on the outcome of their challenge. They're still actively contesting that.
Right.
There's also a dispute over a canceled film studio lease in Jaipur involving Zee Studio Limited that's heading for appeal. So, yeah, it's a testament to the myriad complexities a media giant like this navigates daily.
It really makes you wonder how a company juggles so many of these legal complexities while still trying to push forward with its core business. It certainly paints a picture of constant vigilance.
It does.
Okay, let's pivot then to the balance sheet. As of June 2025, Zee maintained what looks like a healthy cash and treasury investment position, about $21.9 billion.
Yeah.
This includes substantial investments in mutual funds, fixed deposits, and cash. Looks like a strong liquidity position, which is critical for future growth and, strategic flexibility.
Absolutely. And the company also highlighted that its content inventory and advances continued to decline this quarter by about $0.3 billion quarter over quarter, standing at a $70.2 billion now.
And that reflects.
It reflects optimized content acquisition and that strong cost discipline we keep coming back to.
Right. Now, regarding a dip in the cash balance this quarter, what did management say about that?
Yeah, they attributed it mostly to cyclical collections from subscriptions. Apparently, Q4 is typically high for collections, and Q1 sees a bit of a dip.
Timing.
Yeah, timing. And also the deployment of funds into content investments and other operational requirements, basically, working capital needs for the quarter.
Okay. That strong cash position sounds good, but, does it also maybe indicate a potential lack of aggressive investment in new high-growth areas? Or is it purely a strategic reserve for them?
That's a great question. The balance between holding cash and investing for growth.
Yeah. What's the management's outlook now, especially for advertising revenue, given that softness we discussed earlier? Are they still optimistic?
They remain cautiously optimistic, I'd say, especially with the onset of monsoon and the upcoming festive season, which usually helps ad spend.
Right, the festive boost.
Exactly. They are sticking to their FY26 advertising growth guidance of 8%. They're emphasizing new initiatives around retail and content brand integration, which they expect to contribute more in the second half of the fiscal year.
Okay, so growth expected later in the year and future investments.
Well, they plan to continue investing in those new initiatives like the Bullet microdrama app we mentioned, and also a partnership with Ideabus Technology for showcasing unheard stories from Tier 2 and 3 markets.
More new content plays.
Yeah, but importantly, these investments are already factored into their existing margin guidance, so it shows a disciplined approach to spending.
Good governance touch there.
And speaking of governance, they also reinforced their commitment by welcoming 2 new independent directors, Ms. Diva Karani and Mr. Saradakari, to the board.
Okay, good to see. So pulling it all together then, what are the big takeaways from this deep dive into Zee's Q1?
Well, we've seen a company navigating a, let's say, soft advertising market and a pretty flat linear TV subscription landscape. By really doubling down on digital growth with ZEE5, achieving some impressive viewership gains on TV as well, and maintaining quite sharp cost discipline.
Mm-hmm. And they're also actively managing that significant array of legal and regulatory challenges we discussed,
Yeah, that's a big piece.
all while keeping what looks like a strong balance sheet.
Absolutely. And I think understanding these multiple layers of a company's performance, from the financial figures to the operational strategies and those legal battles, it gives you a far more complete and actionable picture than just skimming a news headline.
Definitely.
It truly helps you become well-informed and spot those aha moments, as you said earlier.
Yeah, exactly. So, looking ahead, considering Zee's aggressive digital push and the shifting dynamics of traditional media, how do you think their language-first content strategy and their pursuit of new audiences through platforms like Bullet might redefine what entertainment consumption looks like in India in the next few years?
That's the big question, isn't it?
And maybe, what other surprising innovations might emerge from their focus on both content and technology? Something to think about.